Welcome to our Global Market Review. It's the 11th of April 2019. Let me start with the S&P 500. And probably what's first of all noticeable is a blue line at the bottom of the screen. It represents the trend line from 2009, which is not broken. It was not broken. So that means that the market is still in a strong uptrend from 2009. We know the market has fallen over in October last year and had a base in December 2018. From that base, it started to build a pattern, and that pattern is an inverted head and shoulders pattern. Just drawing in the pattern in front of you, I've just completed what is the left shoulder. Then we've got the market doing its capitulation phase down to that trend line, and then the market has started to and has completed its right shoulder. The completion of the right shoulder has continued with a series of higher highs and higher lows, which is a market breaking to the upside and starting to accelerate in price. Once we've established what is defined as the neckline, which is a line representing the breakout, we can do an estimate based on the depth of the pattern of how far this market will go to the upside. So if I just delete that line just for a moment, and I'm just marking out my chart from the neckline, and I'm just going to contract up the chart. Try that again. Okay, with the chart now scrunched up a little bit, we can see using the depth of the pattern, we have got a target on screen, which is that Fibonacci ratio, which resides above the high of the market at 3106. Now, is it reasonable for the market to get to that level? Well, of course, look at the chart. It's absolutely reasonable for that chart to, or this market to get to that point, and it represents the first level of resistance as the market breaks into a new high. If we go back to last year, from April through to October, the market did a rally. So what is unreasonable for the market to continue on this year and complete its journey up to the first resistance level? There are other resistance levels above that, but I won't go there till we actually reach the first one. And it appears that that's exactly what the market's attempting to do. Other evidence that suggests that this market is in a strong expansionary phase is the information looking at internal numbers, which are the advancing and declining figures within the S&P 500 and the new highs and new lows information. In the context of advancing and declining numbers, 3 weeks ago we had 261 advancing, 212 declining. Last week we had 247 advancing, 226, and I'm reading off the wrong numbers, I apologise, study again. 3 weeks ago we had 247 advancing, 226 declining. Last week we had 287 advancing, 186 declining, and this week we've got 293 advancing and 180 declining within the S&P 500. Now you may hear me say many times, those numbers are interesting, but it's not the number, it's not the raw number, it's the volume of the number which is important. And I can tell you that advancing stocks are 68% higher in volume than declining stocks. Last week that number was 66%. The week prior to that it was in reverse. Declining stocks were 1% greater than advancing. So in the past 3 weeks we've seen a dramatic change in the internal structure of the market, with the volume of advancing coming up to a point which I haven't seen for a long time, which supports the contention this market is starting to accelerate out of its neckline and breaking into new highs. In terms of new highs, new lows, 3 weeks ago we saw 34 new highs, 2 new lows. Last week 37 new highs, 2 new lows. This week 31 new highs, 1 new low. That number is not as important as the advanced decline number, and in the context of the volume of the advancing numbers, That's the really important bit. There is other information that can support the contention that this market is continuing to break the upside. It's the general daily trading information or volume information that I see within the markets, and that is fairly strong. For this market, that is, when I say this market, the S&P 500 to continue to the upside, and for it to, I suppose, forecast an ongoing global rally, the rest of the world has to participate. And when I say the rest of the world, I'm talking about other major indices around the world, not taking away from the mid-cap stocks, which are often a leader, an early leader. They are not bearish, they're bullish, and they're about to break into a potential new high above its neckline. That is IWM, Russell 2000, I've got up on screen. But most importantly, we should be looking at things like the UK market and Germany, Canada, Australia, China. Let's go have a look at each one. First of all, I'm using the exchange-traded funds traded on NYSE representing each of these markets. So first of all, looking at EWU. EWU, if we look at it closely, has had a major break of trend to the upside. It had been trending down. We know the fundamentals that drove that downward trend. It's Brexit, but the negativity from Brexit has already been factored into the market from the low in December, and now the market's broken to the upside, broken trend. That's produced an inverted head and shoulders pattern. It's now doing a series of high highs and higher lows. Essentially, global portfolios are being rebalanced with UK stocks that were chronically oversold. Let's go down to Germany. Again, I'll use the exchange-traded fund. Just give me one moment. Use EWG as the code, and it says a similar picture. If I just open up this chart, we've been in a downward trending mode for a very long time within the German context, but of late, the market has broken trend, and this has only just happened in the last 2 months, completed an inverted head and shoulders pattern, and is starting to do a series of higher highs and higher lows, which define an upward trending market. Not maybe as strong as the UK market, but nonetheless, it is broken trend to the upside. I do have the DAX on screen. It does look a lot stronger when I look at the pattern. Once again, break into new highs as we speak. Let's track across to China. Oh, actually, let me not forget Canada. Looking at the Canadian index, again, this is EWC. It also has done exactly what you would expect in a market that is a commodity-based market. It's done a inverted head and shoulders pattern, which is now complete. Market's broken necklines and is starting to do a series of higher highs and higher lows. I can contract that chart up to see where it's come from. Not as bad as the UK, I don't think, or maybe, as the UK or the Chinese charts or the UK chart. But again, it's stabilised, nice big basing pattern over a long period of time, starting to track to the upside. Let's come over to another one of our markets. Just give me one moment. To China now. Looking at China, I'll look at China through FXI, which is the Exchange Traded Fund. It's a little bit different. It has had an extensive decline over a period of many, many months from 2018. But once again, in the past 2 months, we've seen an accumulation pattern in the form of a W pattern, has confirmed and is now breaking to the upside in a series of higher highs and higher lows. If I go across to the Shanghai Composite chart, it looks absolutely much more dramatic, with these higher highs and higher lows at a much steeper rate of change in price. Let's come down to the Australian market. First of all, looking at the Australian market through EWA. EWA, again, has done a very large inverted head and shoulders pattern. On the right-hand side of screen, we'll note there's a time correction. And that time correction is just giving the market time for the 20-period exponential moving average to catch up to its rate of change in price. It's done that and it's now breaking to the upside. We could look at the Australian market also through its local index, That's the ASX 200, and it's really in a strong uptrend. And also, if I bring that out to a much bigger picture, let's bring it out to a weekly chart, it also has maintained its trend of long-term trend lines since 2009. It simply recently, in the past few months, has come back to that long-term trend line and is now breaking to the upside. If I come back into a much tighter picture of this particular market, opening up the screen, we can see a market which is doing a series of higher highs and higher lows, has had a rest in the past week, but is in alignment with the rest of global markets. The most important takeaway point from all of this is that we've got every single market, obviously I can't cover every single index, but the major global indices are now, for the first time, this is only something that's happened in the past few months, are now synchronized to the upside. There are many fundamentals that we could, discuss that are driving that, but there's no major negative fundamental that's going to stop what I believe is the next expansion in global markets. Of course, there can be negative global macroeconomic, piece of information that we don't know about, but the big ones that we have been following, like Brexit, that's now been delayed to October, and it's not a big fundamental anyway. All the negativity from that was already factored into the chart. We've got China and negotiations of tariff agreements between the United States and China. That's well progressed, and I believe is to the benefit of both countries, and it's stabilised, and the market is now not viewing that as a negative. We've got issues with North Korea, which is ongoing issues, but have receded slightly to the background. And then we've got some local domestic issues within the United States, which come and go, but are not of a global economic nature. They're more of a domestic, very, very White House centric nature, which even if they come out as negatives, are short-lived negatives to the market. The central government, in any central government, singular central government, does not dictate global economic growth, especially in the short term. It's usually much longer, lead-in times with monetary and fiscal policies. So at this point in time, how we're looking at this market for the next months, and I can only look months into the future, technically speaking, it's an ongoing expanding market in all indices around the globe, which should be of most benefit to everyone that owns equities. If you have any questions, you can always contact us. There is a contact, via this website. You can, via the Facebook website, you'll find address details. So please feel free to ask me questions or even post comments on the bottom of this recording. That's it. Thank you.